If your Forex account keeps bleeding and you can't figure out why, chances are it's not the market, it's your hidden habits. Most traders don't blow up because of one giant bad trade but because of repeated small mistakes that quietly drain their balance. In this video, we're breaking down 7 Forex mistakes that are secretly killing your account and exactly how to fix each one. Watch until the end, because the last mistake is the one almost every newer trader makes, and it's usually the final nail in the account coffin. And if you're serious about surviving in Forex long enough to actually become profitable, you need to be able to spot these 7 issues in your own trading. Let's get straight into it. The first silent account killer is risking the same lot size on every trade instead of risking a consistent percentage of your account. This seems harmless at first, but as your account grows or shrinks, that fixed lot size quickly becomes too big or too small relative to your balance. The result is that you're unintentionally overexposed in bad times and underexposed in good times. For example, if you keep trading 0.5 lots whether your account is $500 or $5,000, your actual risk swings wildly without you noticing. A small losing streak with an oversized lot on a smaller account can wipe you out before you even get to adjust. Professional traders think in terms of percentage risk per trade, not lots per trade. A common rule of thumb is to risk 0.5% to 2% of your account on any single trade. If your account is $1,000 and you risk 1%, your maximum loss per trade is $10. Whether you're trading Euros or GBP/JPY, your lot size should be calculated based on that $10 risk and the distance of your stop loss, not pulled out of thin air. The second mistake is using random or emotionally chosen stop losses. Many traders just pick a stop level that feels right, 20 pips here, 50 pips there, without any connection to the actual structure of the market. That's like parking your car in the middle of the street and then acting surprised when it gets hit. Your stop loss should be placed where your trade idea is clearly invalidated, not where it feels emotionally comfortable. For a long trade, that might mean below a major support level, below a swing low, or beyond a key technical zone. If price gets there, it should be obvious that your setup failed, not that you just randomly got shaken out. This also means your stop size might be larger on certain volatile pairs or timeframes. Instead of forcing a tight stop and then getting repeatedly stopped out, adjust your position size so you can place a logical stop while still respecting your percentage risk. Logical stop placement plus proper position sizing beats arbitrary numbers every time. The third mistake is trading without a clearly defined edge. An edge is simply a repeatable condition or set of rules that gives you a statistical advantage over many trades. Most losing traders don't have an edge, they just have vibes, hunches, and random indicators. If you can't clearly describe your setup in 1 or 2 sentences, you probably don't have a real system. For example, I trade bullish breakouts of daily resistance with confirmation from higher timeframe trend and volume is specific and testable. I buy when it looks like it's going up is not. Start by defining which pairs you trade, which timeframes you use, what conditions must be present to enter, and how you manage and exit trades. Then track at least 50 to 100 trades following that plan to see if you actually have a positive expectancy. Without that data, you're just guessing, and guesswork is expensive in Forex. The fourth mistake is overtrading, taking far too many trades or constantly chasing every move you see. This usually comes from a fear of missing out or the belief that more trades automatically mean more profit. In reality, more trades often just mean more fees, more emotional stress, and more opportunities to make mistakes. Overtrading also breaks your strategy because you start taking setups that don't fully meet your rules. Maybe your signal is only half formed, but you jump in anyway because the price is moving fast and you're scared to miss it. Those are usually the trades that lose the fastest. Set a maximum number of trades per day or per week and stick to it. Only take trades that clearly match your written criteria, even if that means sitting on your hands for hours or days. Professional trading is often more about the trades you say no to than the ones you say yes to. The fifth mistake is trading from low timeframes while ignoring the bigger picture. If you're making decisions off the 5-minute chart without checking at least the 1-hour or 4-hour charts, you're trading blind. The higher timeframe trend and key levels often determine whether your trade idea makes sense or not. For example, you might see a nice-looking short signal on the 15-minute chart, but if the daily chart is in a strong uptrend and price is bouncing off major support, that short is fighting a much bigger force. Higher timeframe context turns many perfect setups into obvious traps. Build a routine, start your analysis from the higher timeframe, mark major trends and key levels, then drop down to lower timeframes for precise entries. Always ask, am I trading with the higher timeframe flow or fighting it? Trading with the larger wave dramatically improves your odds. The sixth mistake is emotionally moving your stop loss further away once price starts going against you. This is the classic "I'll just give it a little more room" behavior that turns small, controlled losses into large, account-destroying ones. If your stop is always negotiable, you don't really have a stop. Worse, some traders add to losing positions, hoping to average down until price finally turns around. This can work a few times, which makes it feel smart, until the one time it doesn't, and your account gets crushed in a single move. This is not risk management, it's gambling with extra steps. A better approach is simple: decide your maximum risk per idea, place a logical stop, and do not move it further away. If the market proves you wrong, take the loss, learn from it, and move on to the next opportunity. You can add to winners, but adding to losers should be off the table for serious traders. The seventh mistake, often the most destructive, is not keeping a proper trading journal. If you're not recording your trades and reviewing them, you're repeating the same errors without even realizing it. You can't fix what you never measure. A good journal doesn't need to be complicated, you just need the essentials: date, pair, direction, entry and exit, risk, reward, setup type, and a brief note on why you took the trade. Later, you can review and see which setups perform best and which ones constantly lose money. Over time, your journal becomes a mirror showing your real trading behavior, not the story you tell yourself. You'll spot patterns like, "I lose most when I trade during news," or "My counter-trend trades are killing me." Armed with that information, you can make targeted improvements that actually move the needle. Let's quickly recap the 7 Forex mistakes that are secretly killing your account. Number 1. Risking a fixed lot size instead of a fixed percentage. Number 2. Placing random stop losses with no relation to market structure. Number 3. Trading without a clearly defined edge or system. Number 4. Overtrading and chasing the market out of fear of missing out. Number 5. Ignoring higher timeframes and trading against the bigger trend. Number 6. Moving your stop loss and adding to losing trades instead of cutting them. And number 7. Not journaling or reviewing your trades, so you never actually learn from your mistakes. Fix these 7 areas, and you remove most of the hidden leaks that slowly drain Forex accounts. From here, your next step is simple: pick just one of these 7 mistakes that you recognize in your own trading and fix it this week. Trying to overhaul everything at once is overwhelming. Focusing on one improvement at a time actually sticks. Over a few months, these small changes compound into a completely different trader and a completely different account curve. If you want a quick structure for your next trading session, write this on a sticky note: risk 1% max, trade only A+ setups, follow my plan, and log every trade. Read it before you open your platform and again before you place any order. Over time, that habit alone will separate you from the majority of traders who keep blowing accounts. If you found this helpful, save this video and re-watch the sections that hit hardest whenever you feel yourself slipping, and let me know which of these 7 mistakes you're going to eliminate first. Trade safely, protect your capital, and I'll see you in the next one.